Magandang hapon, Tess.
Magandang hapon.
I know, thank you. So I go away for a few weeks and all of these changes in the mortgage industry.
Well, we have some great news for you. Well, good and bad, I guess.
Yeah, good and
And
bad.
we will
Well, you
talk
know what?
about it.
I don't think overall it's bad, but I don't know if it's necessarily the right move. But we'll go dive into it and kind of dissect these changes. I think it's good for everybody to actually understand what these changes are and how it's actually going to affect, mostly, it's mostly towards first time home buyers. But, let's dive right into it.
Yes, please.
Yeah.
Marami kasing nalilito kung ano ibig sabihin nito. So, let's bring clarity to our
No,
viewers.
for sure. So there's three major changes that's coming. It's not effective yet. Two of them are effective December 15th of this year, and one is effective next month, November 21st. So let's start with one of the big changes is the increasing of that 1 million price cap for insured mortgages from 1 million to 1.5 million. Okay. But yeah, I want to start off by explaining kind of what is an insured mortgage, right?
Mm-hmm.
For the people out there that kind of like, yeah, does that apply to me? So in
Right.
Canada, when you're purchasing property and you're borrowing and you need a mortgage, anything up to $1 million. This is currently anything up to $1 million. You can technically put less than 20% down, right? And that's by insuring it. Insuring meaning that you have to pay an extra premium because for the lenders, if you're not putting 20% down or more, it's considered quote unquote higher risk, right?
Right.
So you have three insurers in Canada that insure mortgages up to that $1 million mark. So that's CMHC, Sagen, and Canada Guarantee. Those are insurers. So up to like now, you can only buy up to 1 million that you can put that less than 20% down. So come December 15th, they're moving that price cap from 1 million to 1.5 million.
What does that
Okay.
mean to our home buyers?
Yeah. So basically you can buy up to 1.5 million now with less than 20% down.
Mm-hmm.
But in turn, you're going to be paying an insurance premium. Okay.
How much are we
So
looking at, Pao?
in terms of insurance premium,
Yeah.
so currently, it was about if you're putting the minimum down payment, uh the insurance premium is 4% of the mortgage amount. So you don't pay
Okay.
that upfront; it gets added to the mortgage. Okay.
Mm-hmm.
So and also the way the calculation works with this new change from 1 million to 1.5. So it's kind of similar to what it is right now. That the minimum down payment that's required is 5% up to the first 500,000, and then 10% from 500 and up is
Okay.
the requirement, the down payment requirement. So just to put numbers so that everybody has an understanding is, so if you're using the max of 1.5 million, okay, your
Mm-hmm.
required down payment would be 5% for the first 500,000, which is 25,000, and then 10% for that anything over. So from the 500 to 1.5, that's $1 million. 10% of that is 100. So you're
Mm-hmm.
required to put $125,000 down. That means you're going to mortgage, 1,375,000, which is, to be honest, this is why I think it's insane, is because it's such a big number to mortgage, especially if you're gearing towards or you're
First
focusing
time
this on
home
first
buyer.
time home buyers, right?
Yeah.
And keep in mind, like I mentioned, it's 4% premium. I believe actually with this price increase, they're increasing the 4% premium to 4.1%. So if you're mortgaging that 1,375,000, the approximate cost of the premium that's going to be added to your mortgage is 56,000.
Is it worth it
Yeah.
to
So,
jump in?
well, like my thought on it is because I think a lot of people have complained. It's like, oh, why is it only 1 million? And I think a lot of people or a lot of experts were saying that maybe a lot of people were hoping that it would increase slightly, but not like 500,000 to 1.5, right? If it was like, I think a lot of experts were saying like, maybe it should be 1,250,000, which is maybe a bit more reasonable, just slightly over, just because of where our house prices are now in Canada,
Mm-hmm.
right? Or mainly Toronto, Vancouver. So that's kind of where our price points are with, like detached homes and whatnot, right? So yeah, to answer your question, is it worth it? Well, I think it is pushing first time home buyers to buy bigger, not not bigger properties, but kind of buy at such a high price point.
They can
And
put as
I
little as 5%.
Yeah, right.
Yeah,
But then you're in the hole for 1.3, 1.4 million, which is for a first time, or
exactly.
is that
It's a
that
lot.
that that,
Yeah,
that that's high risk too, right? Like, because
it is high risk.
it, it is high risk if you're not ideally, if you're, if you're a high income earner. And actually, one thing I wanted to add, for you to even qualify for that, if you're using that 1.5 million and then you have to mortgage 1.3, 1.4 million, you need $300,000 plus of household income, probably 300 to 350 household income. Realistically, how many first time home buyers are in that position where there's a household income of 300,000 or more?
Small very small percentage.
Small
Majority of them
percentage.
probably can't, yeah, afford it.
You're probably looking at, I would say, like roughly 5% of the population are in that
Mm-hmm.
income uh, bracket, right?
Right.
So this one is not really going to make big changes in terms of for first time home buyers, because like it's, mid to high income earners that it's
Yeah,
going to
I just
affect.
Yeah, I just think that for borrowers, it might take on more debt that they can manage. And so it kind of increases long-term financial risk. So I guess they really have to speak to their mortgage advisor. They want to make
Mhm.
sure that they have enough money to sustain the expenses that they would have once they buy this price point. Quite
One is
high.
sustainability, you're correct, but the other is like stability, right? Like with,
Hmm.
with where the economy is, you don't know, like, there's high unemployment. Let's say, god forbid, you lose a job. It's like you're paying, I actually didn't do the calculation for it, what, like close to maybe like 10,000 a month on mortgage payments, which is just crazy. Like if you're, if
It
you
is.
lose your job and then you have high responsibility and high payments like that, right? Like that, the stress factor, right? So I'm not
Yeah,
a big fan of this change, but it is available. Like, I think for anybody that's possibly
can
going to use
afford.
it, if it's slightly
Yes.
over a million, maybe it's something to consider. But I wouldn't advise anybody to put a minimum down payment. If you're buying a $1.5 million house and you only have 125 to put down, maybe you should reconsider buying that property,
Hmm.
right?
Yep. Yeah. I think you should
Mhm.
put in 20% for
and, and
1.5,
and 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 that's why that rule was there. The only
Yeah,
problem was, now the house prices, a million is is like a semi-detached or a townhouse in the GTA.
right.
That's where the problem is. But this doesn't really address the supply
Issue.
issue that we're
Yeah.
having in Toronto. It's kind of accepting the fact that, no, this is kind of our starter home in this area, and it's going to continue to do so, right? Instead of working on building permits and speeding up the process and enticing builders to build more, right?
Yeah. The way I see it is that this new change will only, increase, it could only fuel demand on home prices, right? So it's
Hmm.
just going to increase home prices because of this. A lot more people are probably going to jump in. Well, those ones that are can manage financially, but I think it's just going to worsen the affordability overall.
I agree, because like it's driving more demand and people to be able to afford, but it's not addressing that there's a shortage of supply. The only reason it slowed down is because interest rates were too high, but there people still need housing and people
Right.
want to buy, right? So
Right.
that didn't go away. The population of Canada didn't just disappear because of this high interest. People are just on the sidelines because they can't afford. But now that you're lowering, or you're giving an entry point for people, it's going to eat up the supply pretty quickly, right?
Mm-hmm.
Once rates are
Right.
down again. So,
Yeah, and the thing is, even if they can afford it now, like what you mentioned earlier, once they're in it, $10,000 a month. I
Well,
mean,
don't quote me on the 10,000, but
no, no, no.
it's gonna be ballpark, like, probably like
Right,
seven,
right.
8,000. Yeah.
It's still anything over 5K. I
Mm-hmm.
don't think, like, for the masses, it's not really, it's too much. It's a lot of money,
Mm-hmm.
right? So it's something to think about. They should really think about this carefully. I mean, it's good to have it for those who can
Mm-hmm.
afford financially, but
But
I
it
mean,
just makes
they
me think the people that are stable, and let's say, you have executives that are making, 300, 400,000.
Mhm,
I just don't think they're the market where they're only putting 125,000 like down
right.
payment for a $1.5 million house, right? So these are for people that are like,
Those are the target market.
yeah, like
Yeah.
those people that are way comfortable to be paying those monthly payments are not the people that are putting this low down payment, right? They're putting higher down payments. So,
And that's the thing. And that's the thing. A lot of home buyers, right? They look at the numbers. Okay, 1.5. Okay, I can put as low as 5%, right? And stuff like that. Um, but then they don't think that, a year after, or the consequences, what if the rate goes up?
mhm,
Especially now the stress test will be taken away, you
mhm.
know, when you at a renewal. So there's a lot of risk involved. So I think they should really think about this carefully. It's not for everybody, of course, for
Mhm.
sure.
Yeah, like I said, like, there's nothing like I do, like, the price points are where it's at now. But if you're buying a $1.5 million house, like, you should be putting that 20% down, and you shouldn't be needing this
At the
realistically,
minimum. Yeah,
right? So
agree.
anyway, so that's my take on that, the first one. So again, just to recap, uh, the government is increasing that cap of $1 million for insured mortgages. Insured being, you know, people putting that less than 20% down from. So now the cap is from 1 million to 1.5 million, and that's effective as of December 15th. Okay. So the
All
number
right.
two, which this one I'm a bit more in favor of. Okay. So it's the eligibility of being able to use 30-year amortization to all first time home buyers and to all buyers of new builds. Okay.
Yeah.
So now for f- as of right now, it's if it's an insured mortgage, you can only do up to 25-year amortization. Now it's expanding it to 25 years to 30 years for all first time home buyers, regardless if it's a new build or if it's a resale. But they are also allowing, move up buyers, second time home buyers, to be able to do 30-year amortization if it's a new build or a new construction property. So they are promoting and like new construction properties at this time by but making it more affordable for people, right?
Hmm.
So I think this one is a good thing that I know a lot of people can probably argue, or I don't know, people might comment. It's like, oh, how is that good? Because stretching out, we all know that if you stretch out the amortization, that's overall more interest over the term of the mortgage, right? Because
However, yeah,
you're paying less interest, more interest
mortgage payment.
more interest, sorry, and less principal payments if you're
Right.
stretching it out over from 25 years to 30 years. But keep in mind, this is just so that this is for affordability purposes, right? It doesn't mean that, and our mortgages here in Canada are typically, 5-year terms. You can do 1 to 5 years. That's typical. We're not like the US that has 25-year terms or 30-year terms. So you're not married to that amortization, because come renewal of, let's say, 3 years or 5 years, whichever term that you picked, you can always change. You can almost
Right.
refinance it. Let's say at that point, you got promoted and you have better cash flow. So now from 30 years, and let's say you brought it down to 25 years, technically you can drop it to 15 years or 10 years if you want, right? It's just a matter of affordability. So don't
That's
get
the key.
scared.
Yeah.
Yeah, don't get scared of that 30 years, because that's only for the term of the mortgage, and then you can change it. And also, there are also prepayment options that you can take
Hmm.
advantage of that shortens that amortization, right? And if you do lump sum payments, that goes directly to your principal as well. So there are
Yeah,
ways to do it. So I'm pro for this because it allows you to jump into the market now,
same.
and then talk to your mortgage professional and how you're able to shorten that amortization and also be paying more on principal, right? Because there are ways out there.
Yeah, they can also increase, one of the ways as well is increase their frequency, right?
Hmm.
Of payments. So
Hmm.
if they're doing monthly, they can do semi-monthly, they can do bi-weekly, and they can even do weekly.
Hmm.
And
Which
I like
automatically shortens your
exactly.
amortization.
Yeah,
Hmm.
that thus saves you a lot of money for interest. But I love the idea of throwing lump sum at the end, you know.
Hmm.
But those are just one of the ways to save money on interest. So
Hmm.
again, speak to your mortgage professional. But again, this change will actually increase buying power, and like you said earlier, it lowers the monthly mortgage payments or whatever
Hmm.
payments or frequency they use, because increasing it would lower it, and a lot of people are having issues, paying a high mortgage payment. So increase, I mean, lengthening it to 30-year, like you said, it's going to help. However, they should just remember, and this is the key thing, that they can always change it after, or they can, I mean, if they can break it out, can they, like in between, like like once they do the renewal power, right, 1 3 5 year term, they can always change the amortization. They can lower it instead of 30-year.
Yeah, so that's what I was mentioning earlier is, well, upon renewal you can change it up, right? You can put it back to the original. Let's say you started with 30 years and it dropped to 25 years after 5 years, right, of having the mortgage. You can really, like most lenders would allow you to go back to the original 30 years, right? And then it's a lower amount and then you go back to that, or you can also decrease it, like, because now you can pretty much you'd be more of a refinance at that point
Mm-hmm.
because you're changing it. It's not just a
Right.
renewal, but you can adjust it as accordingly if you want to shorten that amortization from 25 years to 15 years, because now you want to play catch up kind of thing on paying down your mortgage.
Within the term, for example, you're in you apply for a 5-year term, for example,
Hmm.
and it's now the 3rd-year term or the 3rd year. Can you actually change it from 30-year to 25?
Well, it would be a refinance, right? Anytime that
Okay.
because you're breaking the term, so there could be a penalty. So
Mm-hmm.
ideally, you may want to do those changes upon renewal. So just though you're not
Okay.
there's just so there's no penalties, right?
Mm-hmm.
Because anytime that you change the original terms of the mortgage, it will be considered a refinance, and that because you're breaking the original term, right, like the original agreement,
Mm-hmm.
whether it be the rate or the amortization, it would kind of be restructuring the mortgage at that point.
Sounds great.
Hmm.
Okay.
So that's
So,
so yeah, so again, number one, I'm not that big a fan of, but number two, I think allows more people to jump into the market now, and then you can just adjust your amortization for the life of the mortgage to
mhm,
kind of compensate any extra costs that you're incurring because of the longer amortization, right? So
mhm.
that's one and two. Number three, I'm definitely it's
Yes.
definitely a pro.
Pro. Yes.
So now number three is they're eliminating the stress test for renewals for uninsured mortgages.
Yeah.
Okay. So that's definitely a plus. I believe that for the insured mortgages, so the ones that were, less than 20% down, mortgages that people were taking, that was eliminated already to kind of just stir up the competition between banks. Now they're eliminating it, so practically for all mortgages. And
Right.
just to keep in mind, this is only applies for renewals. So this is for when you're switching from one lender to the other. And just to clarify that, because in Canada, when you're just renewing a mortgage with your current lender, you pretty much just renegotiate the rate and the term.
Mhm.
Let's say if your mortgage came up to maturity today, they're going to give you a renewal notice. You don't have to reapply for the mortgage. You just have to pick the term and then you sign, and then, you know what, I want to do another 3 year or 5 year term. So that's the current situation. But That's if you're staying with your existing lender. But
Mm-hmm.
before this changes, if you're going to another lender, they're gonna redo a full application, and then you have to do the stress test, which is whatever the rate is plus 2%, uh, whichever is higher, or the
Mm-hmm.
qualifying rate. But as of right now, it is the plus two. So yeah, so what it's doing is it's not giving any competition to. So if, for instance, if your current lender thinks that, you know what, they probably won't qualify anywhere else, so they're just going to give you whatever rate because of
Right.
that,
Exactly.
because it's impossible for them to go somewhere else. But as of right now, they're eliminating that. They started with the insured mortgages, that they eliminated that stress test for renewals, and now they're doing it for uninsured, and this is effective November 21st. So this is a big plus for everybody because now you can shop your mortgage
Shop
around.
around.
Mhm.
Yes.
But I just wanted to put out that you still need to qualify. If you're going to a different lender, you still need to qualify based on your employment right now and everything. But at least it eliminates that stress test for your current mortgage that is maturing.
What about the terms? Because they are renewing, they can start, I guess, fresh with new terms.
Yeah.
Um,
So it's
and-
because you're moving it. Oh, sorry. Actually, because this is for switch transfer, so this is pretty much
yeah,
if you're doing dollar per dollar.
yeah.
Uh, so yeah, so if you've down to like say 20-year amortization, and then your mortgage is like 400,
Mm-hmm.
you have that has to be the same terms for the new for the with the new lender. The
Mm-hmm.
only thing that's going to be different that you're negotiating is the rate. But
Okay,
the original amortization is going to stay in the amount. The amount and the original amortization stays the same.
that's great news. That's
Hmm.
really great news. It allows a lot of home buyers to, or
Hmm.
um, yeah, home buyers to shop around and get the lowest rate, or I should say the best rates.
Yeah. Well,
Yeah, for them.
definitely the best rate for their situation, right?
Yeah.
So yeah, so those are three major changes that, some of this, like the second one, especially with a 30-year amortization, I think, give it a couple months, I think we can possibly have a busier spring market with this, with coupled
Mm-hmm.
with interest rates decreasing at the
Going down.
moment.
Yeah.
We have two more rate announcements this year, one on October
Third.
23rd and one in December.
Mhm.
I'm not too sure the exact date,
Sometime in
but
December.
sometime
And
in
it's already,
December.
yeah, and it's already expected
Yeah.
by a lot of
Well,
economists. And I
right now, what they're
too.
talking about is even a point 0.5, right? Instead of a
Yes.
0.25
Yeah.
basis point
No, point
decrease.
0.5, point 0.5. And I just
Hmm.
attended the Century 21 conference in Ottawa,
Hmm.
and the Canadian Real Estate Association actually had talk a little bit about this one. And yes, it's gonna be. He's saying that they're looking at point 0.5. Everybody's predicting point 0.5
Hmm.
reduction on the next Bank
I
of Canada announcement.
Yeah, because I think for the most part, if I heard correctly, because the U.S. dropped like the a point 0.5 basis point from not doing any decreases, suddenly does a point 0.5 decrease on their overnight rate. So now Canada would be like more inclined to drop it as well, to
Mm-hmm,
match what the US is doing, right?
mm-hmm. That's
So
right.
but yeah, so anyway, those are the three major changes that's happened in the last couple of weeks, which are like, I think these are like one of the like biggest changes in the last 5 to 10 years in terms of mortgage rules. So it's very significant. So hoping that has a positive outcome in the market. One concern I did have was in terms like what we talked about earlier was the supply issue. It's not really addressing a lot on the supply side. So hopefully we don't get back to like multiple offer scenarios, just because now people are equipped with a 30-year amortization. A bit more people are qualifying for to buy properties, and we don't want a repeat of 2021, when people are just overbidding 50,000, 100,000 on these properties.
Mm-mm. Yeah. Yun ang nga
So
pinag-uusapan ngayon na
mhm.
sabi nila, dahil sa mga changes na nangyari recently, for the last 3 weeks there you were not here.
Exactly, it's crazy.
Ang
Yeah.
s Yeah, so ang prediction is, ang sabi is that by, spring 2025, babalik
Mhm.
tayo sa ano, sa, bidding wars.
Mhm,
Kasi
mhm.
marami na kasi yung mga gustong magbenta ngayon, they're holding off for
Yeah.
now because they know, there's gonna be more reduction in rates. And so you
Mhm,
know what that means, in home prices is gonna go up.
mhm,
Kaya a lot of we're I think, we're predicting a lot of sellers gonna sell their properties in
mhm.
springtime. So
No, exactly. Well, that's also like, I know a lot of people that like had properties that are not a lot of people, a few people that had properties listed for the last 6 months and hasn't been selling, right?
not
So
yet.
now that you're gonna have, on the buyer side, you're equipping the buyers to be able to have more affordability. And then
Mhm.
when the rates go down, that's gonna even, allow more people to be able to buy. So yeah, so I do think I agree that we're probably going to see a busier spring market.
That's right. Yeah, it'll be
Mhm.
busier than last year. I hope. That's what
Yeah.
everybody's expecting,
Mhm. Mhm.
hoping.
Well, that kind of covers all of the major changes that are coming in the next couple of months. And one thing we wanted to touch on, Tess, is how was the market actually last month in terms of sales and the overall market. I believe that you have the Treb numbers.
Last month, I can only talk about last year, year over year.
Oh, year over
Okay.
year.
Yes. I'm sorry about that. I wasn't prepared.
No, 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 no,
Um,
no. Yeah, no.
so for for home sales in the GTA, Greater Toronto area, there's an increase of 8.5% compared last year.
Okay.
Okay. New listings went up by
Mhm.
10.5%. And obviously this gives buyers increased negotiating power. So there's still a lot of listings out there,
Mhm.
inventory. So kasi um, buyers are still sitting on the sideline. I don't
Mhm.
know how long they're gonna wait because it's really expected to get super busy. I'm feeling it already.
Mhm.
I've Some areas are crazy than others because when it's priced right, it goes right, it goes fast. But if not, then it's gonna sit
Stays
for a
in the
while.
market. Yeah.
Yeah. So ang average selling price has declined by 1%, and this is referring to all type of homes. Okay. And the average price is 1.1 for all home types. Now
Okay.
if you go by specific type of homes, for detached the average price is 1.4 in GTA,
Mhm.
semi-detached. So the average price for GTA, average price for detached, sorry, is 1.4. That's down by 1.1.
Mhm.
For semi-detached, it's 1,090,749. It's down by 0.4%. Not too bad. For townhouses, average price is 904,200. It's down by 4%. Condo apartment or condos, average price is 682,543. It's down by 3.6%. So as you can see, townhouses and condo apartments,
Are the ones that are
are
taking a
yeah, it's
a
taking
bigger hit.
longer.
Yeah. Mhm.
That's
Or
right.
yeah.
And
Mhm.
it's taking, this is for all home types, it's taking 27 days
In
last
market.
month,
Mhm.
yeah, on the market compared to 20 days only last year to sell. That's an increase
Okay.
of 35%. That's still, yeah, so we're still there. But I'm
Mhm.
seeing changes now, like in October, there's movement, a little bit of movement. But I think it's gonna only gonna get worse. Or
Well,
I
yeah, we
guess
don't
in
know.
and
Like with I think until this changes come into effect, and keep in mind once the changes come into effect, which is not till next month, December, there's gonna
yeah, it's
be
gonna,
a bit of time before it actually materializes that
yeah, it doesn't
people
take
are,
effect right away. Yeah,
yeah.
you're right. Yeah.
Mhm. So
But
that's
it's
why I'm saying spring is probably
yeah,
more so. And because what are rates? We're probably going to see more rates that are like in the 3% mark by early
September.
I would say no. It probably, because right now it's low fours, right? Like you're seeing low fours for 5-year rates, right? So
Their
that's
prediction
why.
is, yeah, they're predicting that by September of 2025, the
Mhm,
rate will be 2.5%. I'm sure a lot of variable rate holders, they are going to be so happy. And then what you can do from there, you can switch to
mhm.
fix
To
if that
fixed, yeah.
happens. But that's where we're heading, and that's a prediction. We don't know. There's no guarantee.
Well, that's
Um,
something we could take. That's definitely a good strategy. I am starting to talk to clients about taking variable with that
mhm.
idea of that convertibility of a variable from going from, because right now it's still higher than what you can get with a fixed.
Yeah.
But so you write it out until the next 6 months to 12 months, and then you
Mhm.
convert it, and then you lock in at that lower rate, right, at that point.
That's right. Yeah, so I'd say we will see a lot of changes going on in the real estate market, and mortgages, of course, as well, because I know a lot of people are due for renewal in
Mhm,
within 3 to 6 months, I'd say. So that's
mhm,
very soon. And I see here, okay, new listings is up by 10.5% compared last year,
mhm.
and active listings, which is currently on the market right now for all home types, is 36%. It's up 36. So
36%. Okay.
it's high. It's it's
Mhm,
it's still there. Yeah. So hopefully, it's gonna the buyers would go out there. Well, obviously, once I guess it's safer for them, because the rate for them right now, even though it's we're getting some reduction, it's still not. They don't have that much buying power, right? They could probably just afford 500, and there's no 500,000.
mhm.
There's not a lot, but there's there's more offers now for like a lower priced condos compared few years back. But then you know how some people are, they wanted to, even if they're first time buyer, they wanted to like start at a
With a
higher
higher,
price
like
point.
the bigger, yeah.
Yeah, and I keep telling them, just jump in for now, stay for 3 to 5 years, and then take the equity out, and then
Mhm,
upsize later.
mhm.
Yeah,
For sure.
take baby steps. Yeah.
So, definitely. Well, sounds good, Tess. Was there anything else that I missed while I was away? It's like I feel like it's been like so many changes in like 3 weeks that I've been away, and that's
Were
why.
you really
What's that?
sorry? Were you really away? Because you know exactly what just happened. You just went through all the three changes
I
in a
know.
nutshell. I
Yeah.
like.
Well, the good thing is like we're putting this out there before the changes happen, because I actually wanted to try to do it while I was away. Like that's why I was telling you, oh, maybe we should do it because these are major changes, but it is not in effect until November and December.
All
So
right.
I think I just wanted to bring clarity to people,
Mhm.
because even I was telling you earlier, even to myself who's in the mortgage industry for quite some time, sometimes I have to think twice. It's like, okay, this applies to who and which, because
Exactly.
it can be confusing. So anybody that has any questions about it, please feel free to reach out, email, comment, and just message us, and then I'll be happy to address
Mhm.
any questions you have.
Yeah. Yeah, because it is confusing. It's a lot. There's a lot of changes.
Hmm.
So, yun na nga. Kung meron po kayong mga tanong, just write in a comment area, and we'll be happy to address it.
Sounds good, Tess.
Anything else?
And no, I think that's it. And for everybody, if you can subscribe, follow us. It's at Pinoy Homes Canada. And then until the next episode.
That's right. Thank you so much for tuning in.
Okay. Bye, Tess.
Bye, Paolo.